Happy Friday out there, Team 42. It's your skipper here, Darius to present our macro minute for Friday, September 19th, 2025. I hope everyone's having a great week. So, as always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, or to get on the right side of market risk to the extent you haven't been following KISS or Dr. Mo, you need to be a client of 42 Macro. So, today's key macro question is: will BOJ policy normalization upend our paradigm C bull market? Our answer: no, quite the opposite. Today, the BOJ advanced its policy normalization campaign, pledging to begin selling its massive ETF holdings while signaling potential rate hikes later this year. The prospective setup is quite different from how the global macro chessboard was aligned ahead of last summer's yen carry trade unwinds, in that it features a far more favorable outlook for risk assets. Friday's moves underscored UAE's progress in normalizing policy since the spring of 2023, with ETF sales closing the last major chapter of Kuroda era reflation, which amounted to structural regime change that I accurately forecast and helped investors profit from substantially back in the fall of 2012. 13 years later, the current setup regarding U.S. monetary policy feels eerily similar in that regard. Yes, regime change is notoriously hard to forecast, but it happens, and fortunes are routinely made by investors with the data-driven conviction to imagine a world different from today's. And if we're wrong on our paradigm C theme, KISS and Dr. Mo will still help the thousands of investors on Team 42 manage risk appropriately. We don't have to live in fear of being wrong on our fundamental research views, unlike most other investors. Many thanks to the hundreds of investors around the world in our global investor community who have shared testimonials confirming how distressing it has been to trust KISS and Dr. Mo for risk management. All told, the US dollar's exchange rate values versus several major currencies are likely to be much lower 12 to 18 months from now if we continue to be right on our calls for structural regime change at the Fed and the growing geopolitically driven supply-demand imbalance in the Treasury bond market. This implies global liquidity is likely to be much higher over that horizon as well. We learned in April that the alternative, i.e. deflationary paradigm B, is an unacceptable political outcome for the Trump administration. Pay attention to the forest, not the trees. Transition to our 42 macro dashboard. As always, a wrap up with the question from our community. This was titled Educating or Protecting. Phenomenal question. So let me just read it. It says, hello, Darius. I got a long form question, but I think it goes right to the heart of what you do. Part 1, structural asymmetry in the investor ecosystem. We talk a lot about the K-shaped economy, where the top half accumulates assets and the bottom half falls further behind due to the lack of capital or knowledge. But is there also a K-shape within the investing ecosystem itself? Is there a structural dynamic where the top layer of institutional capital front runs major moves, accumulates while retail is inactive, and then triggers reflexive price action only once it's positioned? In this framing, retail isn't a farmer, it is the field itself. Institutional capital doesn't just play the same game better, it plays a different game on a different timeline, often using retail flows as liquidity for exits. Part 2, your role in this landscape. Do you see yourself as someone helping us retail players farm the broader economy more effectively, or do you see yourself more as someone protecting us from being farmed? If it's the latter, do you feel that it puts you in conflict with your original institutional cohort? And context, I've been watching Bitcoin where liquidity meets lack of regulation trade in a stable channel for months. Yet I trust institutionals know the liquidity projections to start turning very Bitcoin friendly in the coming months. My gut says institutions are loading up silently and retail is absent. It feels like a setup. And if I don't have your models and liquidity and signals, I'd be walking straight into an engineered narrative. This dynamic made me think, if it weren't for Darius, I'd be there supplying the exit liquidity. Have a great weekend, my friend. So obviously, phenomenal question, a lot to unpack here. So let me just go back to the start here. So essentially, in this farming, sorry, what's that question? We talk a lot about the K-shaped economy. So what was the question? Yeah, do you see yourself more as someone helping us retail players farm the broader economy more effectively? So obviously that's the yes. We wouldn't be doing what we're doing. We're very mission oriented. Let me sort of take a 30,000 foot view because there's a lot of different aspects of the question that I think I can kind of meld into a more convenient answer here, a more thoughtful answer, which is we started this company because I spent the first 12 years of my career in institutional finance, making rich people richer, helping rich people who were already rich when I got there get richer And by and large, that was the case for pretty much anyone who interacted with me and my team for the first 12 years of my career. Now, we still left when we started 42 Macro half a decade ago. It struck me that I wasn't actually helping anybody. The kinds of people that I left behind to go get rich away from in a new environment, an environment that does not include people like me and the people that I grew up around. And that increasingly started to sit unwell with me. And so what we did when we started this company was to say, hey, we don't. I don't want to use my intellect and the God-given skills that I've been blessed with in terms of institutional macro risk management to only make rich people rich. I want to make everyone rich. Again, it's not about rich versus poor, coastal elite versus Midwestern. It's not a class thing. This is why can't we all just win together? Why can't we have an E-shaped economy and an E-shaped financial markets as opposed to a K-shaped economy and K-shaped financial markets where the people on the top are taking advantage of the people on the bottom? It doesn't have to be that way. Investing is not a zero-sum game. The economy is not a zero-sum game. The economy grows over time. Financial markets grow over time in their capitalization. We don't have to cheat people to get ahead. A lot of you know who exactly I'm talking to right now. And so this concept of cheating people to get ahead is something that doesn't sit well with me. And this is why 42 Macro exists. And so, kind of answering these questions, I think the playing field is a lot more narrow now than it used to be. Certainly when I started in this industry, almost 2 decades ago, there's a real informational asymmetry that existed between retail and institutions. That information asymmetry is narrowed tremendously. In terms of, I would say, the thematic asymmetry is narrowed tremendously. The information asymmetry is definitely not narrowed, but the thematic asymmetry is narrowed. The retail investors understand the mega themes in the markets, almost at the same time they discover them almost roughly around the same time that the institutional investors discover them. Now, the retail investors don't have the ability to generate these mega themes and structural understandings because they don't have the data and the quantitative capability to create these things. They're relying on the trickle down from the institutions. And what I'm essentially saying is because of folks like me and firms like 42 Macro, that trickle down process is dramatically spread up than it relative to what it used to be. It used to be that, you would figure out things like structural regime change at the Fed, a year after it started happening or 2 years after it started happening, after the markets had already moved. Now, because of folks like me providing thought leadership, retail and institutions are finding out about structural regime change at the Fed at the exact same time. And that is new and that it's different. And so I love it. I mean, I love the opportunity set, the current opportunity set for being a retail investor to me, because I think the people who are going to perform the best over the long term from this starting point aren't, retail investors or institutional investors. It's people who combine the competitive advantages of both, in my opinion. Retail investors have a unique competitive advantage of being able to maximize upside capture during bull markets while also being able to sit out bear markets. Institutional investors can't do that. They have to remain fully invested by and large, pick your mandate. And as a function of that, they're constantly trying to take factor risk, partially to outperform the market in bull markets, but also to mitigate drawdown and volatility drag during bear markets. That is a competitive disadvantage relative to retail investors who can just sit out. However, institutional investors have competitive advantages relative to retail investors. Like I said, we have access to all kinds of data and all kinds of proven quantitative techniques that retail investors are unaware of that allow us to actually build the models and back test and stress test the frameworks that allow us to see through the fog and see the forest, not the trees. You're not going to be able to generate a theme like Paradigm C sitting at home with no access to model advanced quantitative techniques or thousands of time series and data sets that go into our monthly macro scouting report presentations. The most recent one was 175 slides. I can't tell you how many thousands of time series were featured in that 175 slide presentation. You're not going to be able to do that as a retail investor. So institutional investors like myself have competitive advantages relative to retail investors, but retail investors like myself, because I consider myself to be at the nexus of both, when I log into my brokerage account, I'm a retail investor. When I log into my computer in the morning, I'm an institutional investor. So, I have the great, privilege of sitting kind of at the nexus of both. And in my opinion, being able to take the competitive advantages from both of these parties and combining them into one return stream or one investment strategy, to me, that's where you're going to win big in this and over the next, let's call it decade plus of investing. Because we're talking about, if we're right on paradigm C, eventually transitioning to paradigm D, we're talking about a continuation of the explosive returns that we're seeing in asset markets, particularly in assets that are exposed to, that help you outrun financial repression and monetary debasement, and or exposed to the productivity boom that's likely to occur as a function of the AI revolution. And it is a revolution, by the way. Check out what I tweeted in my chart of the day this morning. If you can take advantage of that, but also recognize that we are living in an era that requires persistent and accelerating financial repression and monetary debasement, and the institution called the Federal Reserve may not supply it in great enough quantities fast enough at every interval. And so this is why we keep seeing these explosive bull markets, sharp corrections, V-bottom back into explosive bull markets, which is a dynamic we've been observing in global financial markets for the past half decade plus. We've had four V-bottom crashes since 2018. We had four crashes and only two of them V-bottomed in the 20 years prior. In our opinion, this stuff is going to continue. This is the kind of things you should be expecting in a fourth turning. I had a not so famous investor tweet out that the fourth turning is a horoscope, and I would short that tweet if I were you, because if we're learned anything in 2025 is that the fourth turning is not a horoscope. It is a durable and profitable roadmap for investors who want to see through the fog, to focus on the forest and not the trees. And so wrapping up on this question, no, I don't feel that 42 macro puts us into conflict with our original institutional cohort, because I don't want any clients I don't want any customers in my store that feel that the only way they can get ahead is by, weaponizing some sort of asymmetry or taking advantage of another group of investors. That to me is gross. It's wrong. We don't have to live in a K-shaped society. We don't have to live in a K-shaped economy. We can have an E-shaped society, an E-shaped economy, and E-shaped financial markets. There's always going to be rich, there's always going to be poor, and there's always going to be people struggling to get into the middle class. That is true no matter what type of society you have. But we don't have to be moving in the opposite directions. One party doesn't have to be taking advantage of the other parties. We can do it in an E style where we're all moving, we're all going up together, we're all going down together. And that to me is the future of finance. It's the future of this country. It's the future of how we're going to get along together. I don't know if we have to go into the total war that we've typically seen in fourth turnings to get to that outcome, but I think that is the outcome. So I'm very optimistic on the future, and very optimistic on folks who understand that the best possible outcome for you as an investor is to weaponize your competitive advantages as a retail investor, but also to take advantage of the competitive advantages that institutional investors have historically had to produce fantastic outcomes, for your portfolio and ultimately for your family. And so that's why 42 Macro exists. Super passionate about what I do, obviously very mission oriented. We're changing the lives of thousands of investors around the world. You can check it. Spend some time on our testimonials page. You don't have to listen to me sit here and bloviate about how awesome we are. You can listen to our clients tell you exactly the positive impact that we're having on them and their families. And I'm super proud of that. So we'll wrap it up there. Everyone have a wonderful weekend. We'll catch you back here on Monday. Cheers.